And it sure looks like the economy is doing surprisingly well in the third quarter, better than 3%. I'm not convinced that the trend rate of growth has gotten to that level, but it's certainly encouraging. A lot of it probably has to do with the temporary jolt from the fiscal stimulus that we got from the tax cut.
So you think if we are having this conversation 12 months from now, things will look different?
Yes, I think the rate of growth will be closer to 2.5%.
Because?
Maybe less. Because productivity isn't growing very fast, because the Trump tariffs will create inefficiencies that will slow the economy, and because the Fed will be raising interest rates because they think we're pretty much at full employment.
And do you think the Fed's in line with your view at this point?
Yes. I think will be interesting to see what they do with their forecast when the Survey of Economic Projections comes out. But they seem to be suggesting that the economy is very close to its capacity, and that they don't see that capacity, that trend rate of growth, growing anywhere near as fast as the president is hoping.
One of the big issues remains wage growth, though clearly wages are increasing, and we're finally seeing a bit of an uptick. An interesting piece we were talking about during the commercial break that Binyai Applebaum has this morning, suggesting that some of the money that historically would go into your pocket has gone into the form of perks, and how the Fed is either adjusting or calculating for that, and whether that even should be in the calculus of how we think about wage growth.
Well, yeah, I mean, we think about wage growth as total compensation, and one of the things that the recent data has suggested is that not only are benefits growing faster than money wages, but more and more people are getting bonuses. Employers seem to have figured out if you give someone a bonus, they love it, and it's a one-off. You don't have to do it again. So when the Fed is looking at whether to tighten now, they're looking at overall wage compensation. And I think that, it's making up for a lot of lost time.
How does that, I mean, if we're trying to figure out if there's wage inflation creeping in, if you were actually to look at compensation, how do those numbers fare up? And is there a number we should be watching more for?
Well, yeah, I think there's something called the ECI, the Employment Cost Index, which factors in both wages and benefits. I haven't looked at the numbers lately, but it's been creeping up like everything else. But look, for the Fed, it's basically a very simple choice. It's just hard to know. What is the bigger risk? Is the bigger risk that we're going to get a lot more inflation than they anticipate, more than just 2.2% or something like that? So they should be tightening because they see the job market so strong? Or do they say, worrying about the risks, maybe the risks are more on the downside? You have all this turmoil overseas, strong dollar, and tariff.
But I think it's even more than that. Are they anticipating the proper economic growth, the right GDP numbers, or if they raise their GDP expectations, does that in turn mean that they will have to raise rates a little more rapidly?
No, I think this is going to be they're going to be feeling around like someone crossing a river, feeling for the stones. I don't think Jay Powell is a model-dependent guy the way some of his predecessors were. I don't think they're going to lock themselves into 4 rate increases next year. I think that they will be looking to see just that. If you don't see any inflation, if you see job growth continuing to be strong, but wages are increasing very slowly, that leads you to believe that the potential growth of the economy has gone up. I don't think that's what they expect, but I think that they will be, and I think a lot of them doubt that's going to happen.
But it's interesting that he's not a models guy. Maybe he goes more with his gut and feels things out, but maybe the market needs to recognize that it's not going to be telegraphed quite as neatly as it has been to this point.
I think that's absolutely true. I think people are going to have to get used to the fact that during the crisis and the slow recovery, the Fed had a deliberate policy of saying, we are not going to raise rates, relax, even though the economy's picking up steam, the bond market, don't push up yields. They're going to try and wean the market off that, and that's going to be unsettling for some people. Some people may not remember a day when the Fed didn't tell you what they're going to do for the next 18 months.
So when everyone's going to try to divine and sort of read between the lines today at this press conference, what's the thing you're looking for?
That's a good question. I think that what I'm most interested in is how he describes the dots. One of the things that was so amusing about Janet Yellen is she had a rather ambivalent relationship with the dots, the projections that the Fed makes for future interest rates. When they were in line with what she wanted, she would cite them as an indication of where things were going. And when they weren't what she wanted, she would kind of diss them. So I'm interested. We'll see. There's some new members of the committee. We'll see the dots going up. Does Jay Powell do they speak for him, or is he going to speak against the dots?